You're watching Business Incorporated live from Channels HQ. Coming up, the Bank of Ghana announces that it will hold its first Monetary Policy Committee meeting for 2023, January 24th to 27th. And Egypt's gold reserves inched up to $7.32 billion at the end of December 2022. Kenya's private sector activity picked up for a second month in a row in December. Hello and welcome to the program. I'm Ladi Williams. Let's kick off with the markets. Now let's see how your money is performing at intraday, starting with the African continent. We see equities trading in mostly positive sentiment there. We see the NGX continuing that bullish run, though marginal. It's up 0.09% at 51,704 points. And I saw stocks like Boa Foods and financial services stocks like GT Bank and Zenith actually leading the pack, leading to this marginal gain. Interesting to see how the market closes at the close of trade today. South Africa that's up 1.08% at 75,000 points. Let's look at other parts we track. With North Africa, their seats up 2.68%, and the all-share index at the 15,000 level, almost getting to 16,000. And we see Kenya, they're closing yesterday positive, up 0.31%. Let's move over to other markets we track now. The Middle East, we see the sentiment there is mostly mixed. At intraday, we're seeing positive, just a negative sentiment, 0.71% down for Abu Dhabi. In the UAE, squarely negative sentiment. And other markets we track there, just the Qatari index with a big move up, 2.77%. While Saudi Arabia, that's at intraday, 10,487 points. It's down 0.42%. So it's mostly negative sentiment we're seeing in the Middle East. Let's move over to Europe now. We see the EU is strongly recommending its members impose a COVID testing requirement on travelers coming from China. The idea of split member states upset Beijing and irritated the airline industry. Let's talk to Rob Watts right there in Berlin. Great to have you, Rob. So is the EU united over how best to handle China's reopening to the world?
Well, not quite, no. Health experts from across the bloc have been meeting for the last week in an effort to come up with a strategy for the whole of the EU, but they have fallen short of agreeing to common restrictions. What we have instead is the European Commission strongly encouraging member states to require passengers coming from China to have taken a COVID-19 test and to have tested negative before they set off for the EU. Now, this is a measure that some states have already introduced unilaterally, namely Italy, France and Spain, but others, such as here in Germany, they've held off on imposing any restrictions yet. The strong recommendation from the EU's Integrated Political Crisis Response Group, as it's called, actually flies in the face of some other advice from another EU body, its Disease Prevention Agency, which only last week said testing was unjustified because of the high rates of vaccination in the EU, and also the fact that variants circulating in China are already present within the European Union.
And how has the proposal to impose a test requirement on Chinese travelers gone down with Beijing and the airline industry?
Well, let's start off with the airline industry. The International Air Transport Association, which represents 300 carriers worldwide, has been very quick to condemn the EU's recommendation. It says it's extremely disappointing to see what it calls a knee-jerk reinstatement of measures that have proven ineffective over the last 3 years. The enormous impact, obviously, of COVID restrictions on the aviation industry is still very fresh in the memory of airlines, and they would also clearly like to begin flying millions of Chinese passengers around the world once more. As for the reaction in Beijing, it's accusing the EU of having ulterior motives for imposing further restrictions on travellers from China. A spokesperson said the Chinese government sincerely hopes all parties will focus on fighting the epidemic itself and avoid the politicisation of COVID.
All right, let's look at the markets now. I know European markets were looking good yesterday. How's it looking today?
Well, the big story here is natural gas. On Wednesday, wholesale gas prices hit their lowest level since November of 2021. That is a big deal because it suggests the damage done by Russia's war in Ukraine to European gas markets has been, to some extent, undone. European countries have seen a particularly mild winter, with winter temperature records being broken in many countries, and that has meant that there's much lower demand for natural gas this winter than there has been in previous winters. European stocks have received a boost also from more encouraging inflation figures. This time they came from France. Prices in France rose at a slower rate last month than the record high of the previous month, and that added to the optimism generated by figures from Germany earlier this week. There is a growing hope that inflation within the Eurozone has passed its peak, and that's one aspect driving the general feeling of optimism on global markets in the first trading week of 2023.
All right, but looking out for today's close. Thank you so much, Rob Ratt, right there in Berlin. That was Rob giving us the details from Europe. Now let's move on to the UK. Well, from last year, we had the sound of job cuts and forecasts from major tech companies. And right now we have Juliana there to give us the update in UK. Great to have you, Juliana. So it's Amazon this time. They're announcing they're going to cut 18,000 jobs. That's the biggest round of layoffs in the company's history. And I understand that the UK is going to be affected.
Good afternoon, Laddie. Yes, we do believe that the UK is going to be affected. However, Andy Jassy, who is the CEO of the world's largest retailer, he's released a statement saying, kind of hold your horses. This was a leaked memo that was supposed to be internal. The job cuts are not coming until this time next year. But anyway, everybody's talking about it at the moment. And of course, not great if you are going to be one of these 18,000. According to some reports, this is going to be affecting those who work in audio division. I believe Alexa. So if you're somebody who works in Alexa audio, not great for you and not great for the sector, really, because if we go back a couple of years, remember during 2020, it was the big tech titans like Amazon, like Google, and all of the rest of them that were benefiting from the fact that millions of people were staying at home. They saw their share prices skyrocket, and the demand for their goods and services was extreme, particularly Amazon, because of course they go through a vast swathe of sectors, predominantly retail, but certainly when it comes to deliveries. Now, since the world has changed, consumer habits have also changed, and I think they were gearing up for something like this. They did announce in November that they were going to lay off about 10,000 staff. That's been increased to about 18,000. So yes, not great if you are one of those 18,000, but let's bear in mind that Amazon have over 1.5 million people working for them. I believe they are one of, if not the largest private sector employer in the world. But it does go to show that this is the mood music of the season. And I think we're probably going to be expecting more job cuts from big tech companies to come in 2023. I believe it was just last week that Snapchat, remember that, Laddie? I don't use it. I'm sure you've got a profile. They laid off a few thousand staff as well too. So yes, not great, but it does show that these big companies are having to change their workforce if they want to reduce, the amount of money they're spending every month and stay competitive.
Yeah, quite interesting. The big tech companies now seeing that fewer people can do the same job at this time. But let's look at the first address for 2023. That's Rishi Sunak there. Gave his first address for the year. Any promises for the UK economy?
Well, yes, loads of promises. I'm not sure if it lived up to much, but hey, at least he has addressed the public. This came yesterday afternoon, Rishi Sunak, the Prime Minister, using what some people would say is a platform that he didn't have during the Conservative Party conference just before Liz Truss was ousted and he was given the crown of Prime Minister. He doesn't have, that populist personality and the charisma of his predecessor, Boris Johnson, or probably any other prime minister. It didn't really go according to plan. But I think the big takeaways are really those 5-point pledges which he has promised, one of them being to halve inflation, the other to reduce debt, to cut NHS waiting lists, which is an acute issue at the moment, to stop migrant crossings and to grow the economy. And they are, of course, ambitious pledges. The only issue being with the address he gave yesterday is he failed to discuss the elephant in the room, the elephant being these industrial actions that are crippling the British economy and affecting commuters. Millions of people have been asked to work from home because this week we're seeing a number of strikes from rail workers. In fact, back-to-back 48-hour workouts. It's not just the RMT, they're being joined by the ASLEF union. He hasn't mentioned that. Ambulance workers, NHS staff, they are going to be striking later in the month. Is he going to negotiate with them? He didn't mention that too. So yes, lots of kind of vague, open-ended promises, which is good because, of course, we do want to halve inflation. We do want to reduce debt. We do want to grow the economy, but we need to tackle the urgent issues first. We did have a statement earlier today by Sir Keir Starmer, the opposition Labour Party leader, and he described Rishi Sunak's speech as thin. Prime Minister's questions resumes next week. Lawmakers will be sitting in the House of Commons on Monday. And there is no way he is going to be able to hide from these really difficult questions. He did say when he was Chancellor during the pandemic, whatever it takes. And I think now households on the brink, union bosses angered, businesses beleaguered are saying that the Prime Minister needs to repeat the statement he made last time and saying whatever it takes to get us out of really difficult times in the UK, Laddie.
Whatever it takes. Well, so much on Rishi Sunak's plate for 2023. We'll be watching how he handles all of these going on. Well, let's look at the markets now. How's it looking at intraday in the UK?
Looking pretty good. The New Year lift is still lifting. I think it's been helped really by data released by Kantar today, showing that retail sales, at least in grocery retail sales, in the 4 weeks to December the 25th were exceptional. £12.9 billion was spent at the checkout. This is a 9% year-on-year high, one of the highest spending months on record. So even though people are still strapped for cash, I think people are desperate to have a loving Christmas and make sure there's enough gifts under the tree and enough supper on the Christmas table. So that lifted lots of retailers in the UK who were the top risers on the blue chip index at intraday. The all share is up 0.39%. FTSE 100 up by 0.43%, and the FTSE 250, the domestic market, up by nearly 0.5%. In the currencies market, the British pound is currently trading down against the US dollar, down by 0.27%, down 2 against the euro by 0.36%, and down 2 against the Japanese yen by 0.03%, Laddie.
Right, I know global investors in risk assets can't wait to make profit, in 2023. Definitely a rough, 2022 for all of them. All right, thank you so much, Juliana. Thank you.
Thank you.
That was Juliana there giving us the details from the UK. And let's head on to other markets now. We see Asia-Pacific markets climbed as investors shrugged off the U.S. Federal Reserve's commitment to higher interest rates in tackling inflation. Mainland China's Shenzhen component was up 2.13%, closing at 11,332 points, while the Shanghai Composite rose 1.01% to 3,155 points. Australia's S&P ASX 200 ended fractionally higher at 7,063 points. In Japan, the Nikkei 225 was up 0.40% at 25,820 points, while the Topix added 0.04% to close at 1,868 points. The Kospi rose 0.38% to end at 2,264 points, and the Kosdaq lost 0.55% to close at 679.92 points. Hong Kong's Hang Seng Index jumped 1.38% in the final hour of trade, pairing some of its earlier gains of more than 2% as investors digested an improved reading in China's Caixin Services Purchasing Managers Index for December, while Hong Kong's S&P Purchasing Managers Index also showed eased pressure in the factory activity. And stock futures were flat today as investors looked beyond the hawkishness of the Federal Reserve's meeting minutes released in the afternoon towards labor data coming later this week. There we see behind me the Dow Industrial Average futures there. It's down marginally about 0.03%, while the S&P 500 stays unchanged, 3,876 points, while the tech-heavy NASDAQ lost at the 11,000 level, down 0.02%. We're interested to see how the markets in the U.S. close later today. I'll take a break now. When we come back, more stories from the African continent. Do stay with us. This is Business Incorporated. Welcome back. You're watching Business Incorporated live, channel of television. Let's move over to North Africa now. See Egypt's gold reserves, a major component of foreign cash reserves, inched up $7.32 billion at the end of December 2022 from $7.07 billion at the end of November, according to central bank data. The country's net foreign reserves surged $34.002 billion at the end of December from $33.532 billion at the end of November. Foreign currencies in Egypt's foreign reserves include the US dollar, euro, Australian dollar, Japanese yen, and Chinese yuan. The provision of foreign exchange, including gold and various international currencies, is designed to pay for imports, repay foreign debts, and cope with any economic crisis in exceptional circumstances. All right, now let's move on to other markets now. Liquefied natural gas. See, that's Nigeria's major export commodity, accounting for approximately 14% of total exports with a value of $10 billion. The price of natural gas in the global markets is falling sharply by over 50% since its high of about $9.12 per MMBTU at the start of the Russia-Ukraine war. Let's talk to Oluwatomi Mayowa now, Senior Analyst, Financial Derivatives Company. Join us via Zoom. Great to have you on the show.
Thank you very much, Gladys.
Yeah, so we're seeing this plunge now. Yeah, Happy New Year. We're seeing this plunge now with LNG, natural gas prices. And obviously, I'm trying to understand why are the prices really going down? Is it that it's gotten to its peak, so it's time to go down, or is there just less demand for natural gas?
Well, I would like to say that it's actually good news for Europe, especially knowing that it was a major stoking factor for inflation, for the past months. But recently, the price of natural gas has actually fallen. Why are we seeing this? One, I can say that the European countries have actually stocked up for the winter period, and the weather for the winter actually came in, less. It wasn't as cold as as expected. And then there's the weather, a warm weather forecast, and as a result of that, there's been less demand for natural gas, and so that's why we're seeing this. And who knows, it may not be so bad for the European countries as we expected in terms of recession as a result of this, actually.
And obviously, we saw all the commodities that hit new highs last year, all trending downward. But how would this impact the naira and the forex market in Nigeria?
Well, it's actually, as you said, that it's 14% of our total exports, and as a result of that, if the price of the price of natural gas has actually fallen, that's going to lead to a decline in our external earnings because it's our second major export, right? So as a result of that, it's difficult for the fiscal revenue to increase because it's then we know the whole story of debts and all of that. So it might be difficult for the federal government to finance its budget as a result of a lower revenue, because it's a major part of the government's revenue. And then it might be difficult also for the supply forex into the market. There could be forex restrictions. There could be forex rationing. And you know what that means? Manufacturers will have to, go to the parallel market to be able to get their dollars. And as a result of that, that will lead to high demand pressure. And definitely you see depreciation in the parallel market still.
And obviously, we've seen, ramping up of alternative gas projects, globally with Europe trying to, wean off Russian gas. And I'm wondering if the war just, ends abruptly, what happens to all those projects?
Yeah, if the war ends today, definitely what we'll see is the sanctions on the Russian economy, maybe lifted, and then the Russian economy, I mean the Russian will be able Russia will be able to actually export gas to Europe, and definitely that will lead to lower gas price as compared to what it was before. And well, what one thing we must not forget is that there's this transitioning to cleaner energy, right? And so as a result of that, there's still large market potential or huge market potential for the demand for natural gas, because natural gas is actually a cleaner form of energy compared to other petroleum products like kerosene, coal, and all of that. So there's still that huge market potential for natural gas. So the demand will still be there.
And obviously, I know even though the war ends, the U.S. and its allies might not be, fond of Russia, even going forward. This definitely has a long-term, implications. But let's look at the price of cooking gas, in Nigeria. Obviously, cooking gas has been over 100% up, most of 2022. What are you seeing for 2023?
Well, that's been increased investments in the industry in terms of production of cooking gas in Nigeria. I think as our last year, January, the NLNG said they were going to Nigeria was going to be sufficient in terms of self-sufficient in terms of gas production. And that's cooking gas production actually. But we didn't see that because there was still imports of cooking gas. I think over about 50%, of what we consume is still being imported. And then they're saying that because there's less, the investment in that industry is still not enough, because there need to be more investment in order to increase the production. And then there's still the irregular supply from the upstream sector because of the crude oil theft, because mainly in Nigeria, we use crude oil for the production of the LPG, which is the cooking gas. Unlike it can be used, raw natural gas can be used in the production, and then crude oil. But for Nigeria, we use crude oil. So there's been that irregular supply from the upstream sector. And so that's why we're saying that. But then there'll be more companies coming into stream. And I think we'll see more of that this year. And so we would see that the increased production of cooking gas in Nigeria. But then I do not think that in 2023 we might be self-sufficient. But then I will still see that increasing.
All right, I definitely want to pay lower for cooking gas going forward. Thank you so much, Oluwatomi Maiwa, Senior Analyst at Financial Derivatives Company. It was great having your perspective today. Thank you so much.
Thank you very much.
All right, now let's move into all the stories. Now, see, the Bank of Ghana has announced that it will hold its first Monetary Policy Committee meeting for 2023 from Tuesday, January 24th to Friday, January 27th to review developments in the economy. The meeting, which will be the 110th is expected to heavily discuss Ghana's high inflation rate, which stands at 50.3%, the highest in 27 years. Also, the committee will use the meeting to decide whether to hike the policy rate, maintain it, or reduce it. And Kenya's private sector activity picked up for a second month in a row in December, and helped by easing inflation, increased demand, and favorable weather, according to a survey. The S&P Global Kenya Purchasing Managers Index jumped to 51.6 points in December from 50.9 points a month earlier. Readings above 50% signal growth in business activity, while those below point to a contraction. S&P Global saw a rise in activity, cited higher sales, increased marketing, favorable weather conditions, and slowing inflationary pressures. And that's it on Business Incorporated. Thank you so much for watching. I'm Ladi Williams. Bye for now.